thank you for coming out. We're very thrilled to have you here at MaRS for the Wealthsimple Lunch and Learn. As for some of you that don't know, I know there's a lot of MaRS tenants that live in the building here, and there's a lot of MaRS staff, but there's a lot of folks outside of the MaRS community that are here, so welcome. Just quickly, MaRS is Canada's largest innovations and entrepreneurial hub. I think we touch over 1,000 startups. Actually, I think the number is closer to 11 or 1,200. That spans across a couple different sectors like ICT, digital health, clean technology. And in February of this year, we actually launched a financial technology cluster, and I'm actually the head of that group. And we're very happy to have the folks from Wealthsimple, who are one of our fintech ventures, part of the MaRS family, here today. Amazing success story. I won't steal their thunder, but 7-8 months ago, these guys were sort of 3 people. Now I'll let them tell you where they are today, but they've raised almost $30 million worth of capital, and they are just doing some amazing things. So very excited for them to be here. We do a ton of different events here at MaRS. Last night we actually had, I think, North America's largest cryptocurrency Bitcoin meetup. We had about 400 people here. We had a bunch of folks from New York. We have Richard Branson here. We have Walter Isaacson here. We do a lot of different events. So very thrilled to have an event around fintech here at MaRS. I'm going to introduce Andrew D'Souza and Mike Katchen from Wealthsimple. Enjoy the lunch and enjoy the session. Thanks.
Hey everyone, thanks a lot, Adam, and thanks for coming. So I'm an investor, advisor, customer of Wealthsimple. Mike and I have known each other for a long time. We met working together at McKinsey here in Toronto, and then we both moved down to San Francisco, and we took McKinsey off our resumes because in San Francisco that gets you no street cred. And so it was actually, I think I played a small part in Mike making the transition from kind of corporate suit-wearing business person to tech entrepreneur. I remember he was going to join a private equity shop here in Toronto, and then got a call from a friend of his that had just gotten into Y Combinator, which is a great accelerator down in Silicon Valley. And so he flew down and he chatted with the team there, and then we went out for beers for a couple hours and picked my brain. I had moved down there about a year before, picked my brain, and I think he ended up joining that team. I think he made the right decision. He then. That company got acquired by Ancestry.com. He moved back to Toronto, again, about a year after I had moved back to Toronto, so I think he was kind of following me around. But we were chatting about, as he was running Ancestry Canada, he was trying to think about what was next, and we were talking about some of the industries and market opportunities that we thought were really exciting. And financial services came up as one that seemed like a huge opportunity, ripe for disruption, a lot of opportunity for improvement. And so a couple months later, when Mike mentioned that he was building Wealthsimple and he was putting the team that he had gotten together, I asked if I could invest. And I actually needed him to build this company because most of my personal net worth is in private tech startups, and so I needed the diversification that Wealthsimple provides. And so I am a proud investor, advisor, customer of Wealthsimple, and it's my honor to introduce my friend Mike Katchen to tell you a little bit about what they do.
Thanks, man. Yeah, sure. That's awesome. Wow. Can everybody hear me okay? Mic's working? Awesome. Well, thank you so much for coming. I was just reminiscing with Adam. The last time I was on the stage was September of last year, so just 10 months ago, when Wealthsimple was a team of 3 people. We'd raised a very small amount of capital to get the business off the ground, and we were selected somehow to be part of the CIX Top 20 program. And here we are 10 months later. We've raised $30 million in capital, are growing, we have thousands of clients that we work with today. We're growing at about 5 or 10% a week. It's just been amazing. A big part of our mission at the company is to try to help everyone become a smarter investor. So the service we provide is we actually help people by managing their money for them. So we make it really easy to set up a broadly diversified portfolio, rebalance it regularly, and we do it all for a really low fee relative to what most Canadians pay. But a big part that's on the side to that mission is trying to help enable other investors to be smarter about how to manage their money. So we do a lot of what we call these lunch and learns, where we go into companies, big groups of people, and talk about what we call the 5 basic rules of smart investing. So today is not designed to be a Wealthsimple pitch. It's really about equipping you with the knowledge that you need to be a better investor. So we're going to walk through these rules, and whatever you're doing today, whether you're managing your own money or you're working with a traditional advisor, if you stick to these 5 rules, you're going to set yourself up for really great long-term success. Okay? So I'll start by saying, whatever you think you know about investing, I'll ask you to throw that out. I'd like to start from square one. And when it comes to investing, the only thing that matters is to focus on the few things that you can control and take a really long-term perspective. Everything else is noise. You know, we hear a lot of noise these days. I don't know if anybody saw at 10 a.m. this morning the interest rate announcement that came out from the Bank of Canada. But all of that is noise when it comes to long-term investing success. And here we go, the 5 simple rules. Rule number 1, you got to start early. Who here is an investor today? Who has investments? Awesome. I see most people have their hands up, but some of you don't. So I got to encourage those of you that don't. There is nothing holding you back from starting today. Okay, there's no such thing as the perfect investment. There's no reason to wait if you're thinking about buying a house in a little while. There's no better time to invest, and here's why. Okay, Einstein, I'm not sure if this is true, but it's a widely held truism that Einstein called a compound interest mankind's greatest discovery. Okay, so if someone like Einstein says something about compound interest in investing that way, I think it's worth paying attention to. And here's a very simple example to explain it. Imagine we have 2 friends, right? One's 30, one's 40 years old. They each start putting away $5,000 a year until the time they retire at 65. So by the time they retire, the 30-year-old will have invested $175,000, the 40-year-old $125,000. Right, so $50,000 difference. It might seem like a lot, but $5,000 a year as everybody continues to build wealth, continues to develop in their careers, you can imagine putting away over the long term $5,000 a year. How much does $5,000 a year, or the $50,000 difference, turn into as a result of compounding over time? Any guesses? 100,000? Closer to $500,000. Okay, it's a truly material amount of money that you could leave on the table by getting started late. You know, $500,000 is such a huge amount when you think about your lifestyle. This is paying off a mortgage. This is if you've paid off your mortgage. This could be buying a second home. This could be sending your kids to college. This is a truly transformative amount of wealth that a lot of people leave on the table because they don't start early. So if you're not investing, you got to get started. That's rule number 1. Rule number 2. Don't pick stocks. A lot of us have this conception that really thoughtful investing is about sitting behind a computer, kind of analyzing all of this data about where interest rates are moving, how currencies are moving, you know, where are oil prices going, and interpreting that to guess, you know, where the price of Tesla is going to be next week. That doesn't work. I love this little anecdote. You guys can probably see these behind me, but back in the 1990s, the Wall Street Journal used to run this amazing experiment where every Friday, they would dress up one of their editors in a monkey suit. They would paste the stock section in the newspaper on a dartboard, and they'd have them throw 1 dart, okay, at the paper on the dartboard. And that would become the stock pick of the week. And then they would hire 2 professional stock pickers to try to beat the monkey's pick. Okay? They ran this experiment for the better part of a few years. What percentage of the time do you think the professionals beat the monkey suit? Again, any guesses? So a little higher than 0. It was 50% of the time. What's amazing about that is that's random chance. So you've got someone throwing darts at a dartboard, competing against professionals, and they're no better than random chance. I mean, it's pretty remarkable when you think about it. And the really sad truth is the data from the industry is no different. If you look, and this is Canadian data, if you look across a few different types of what we call asset classes, so asset types like Canadian equities, international equities, you know, these are stocks and companies, and bonds, you see that the vast majority of professional investment managers, the people that are trying to pick stocks or bonds to beat their market indexes, fail to do so in any given year. Okay, this is between 70 and almost 100% of people in any given year. It's important to know this is net of fees, right? So after fees, very few professionals actually beat just the market index. And this is in 1 year. So if you actually think about this over any period of time, Very few do it with any consistency. This is why we only have one Warren Buffett. If it was easy to do, we've had a lot more billionaires that were making wealth over picking stocks over the long term. And I like to tell this personal anecdote to just kind of make it a little bit more real for people. This is me at 12 years old. This is when I bought my first stock. I won my very first stock picking contest at 12. It was 1999. It was an 8-week contest run by Canada Trust. This is before it became TD Canada Trust, and TD bought the bank. And you got to pick a stock, or 10 stocks. I decided to pick one. It was called MGI Software. In the period of 8 weeks, it went up 256%. I won a free trip for my dad and I to Whistler. Right? Awesome thing. So when I won the contest, the stock was up 260% in 8 weeks. What happened next? This is 1999. MGI Software, right? Tech company. So when I won the contest, the stock was trading at $24.40. 2 years later, the company was sold for $1.18. This is the risk of stock picking. I didn't see this coming. None of the professionals saw this coming. And when you concentrate all your wealth in a single stock or a single bet, you can have a catastrophe like this. And a lot of people experienced this back in 99, 2000, and again in 2008. So this is why it's really thoughtful not to be a stock picker, but instead to build really broadly diversified portfolios. And we're going to talk about that in a second. Rule number 3, you got to keep your costs low. Okay, generally, when we think about things in life, things we like, nice jewelry, cars, generally the more we pay, usually the nicer the thing is. Really nice jewelry tends to be more expensive. In investing, it's the opposite. Generally, the more you pay for something, the worse it is. Okay, and why that's particularly important for us here in this room is Canadians pay the highest fees of any country in the world when it comes to investing. The average Canadian is paying almost 2.5% for what's called an equity mutual fund, so just a mutual fund of stocks, whereas people in the US are paying 0.8%. It's a remarkable difference. And a lot of people look at this and they kind of shrug it off because they say, 1.6% a year doesn't really feel like that much money, right? And maybe today you're only investing a couple $100, a couple $1,000. Doesn't feel like that much. How much does 1.6% translate into over the long term? We talked a little bit about the importance of getting started early because of compound interest. Well, the same holds true for costs. So if you assume that 2 friends each invest $100,000 at the same time and wait 30 years, one's Canadian, one's American, so one's paying the Canadian fees, one's paying the American fees, this is the difference in where they're going to end up 30 years from now. It turns into $300,000. So tremendous, loss due to paying too much in fees that we suffer from in this country. So as a general rule, keep your costs less than 1%. Your all-in cost less than 1%. You can actually do a lot better than that, and we'll walk through how you might be able to do it on your own and keep them even closer to 0.5% or less. But if you can keep it less than 1%, you're going to be in really great shape for long-term success. Okay? Rule number 4, you got to diversify. Okay, we've all heard of this concept of don't keep all your eggs in one basket. But it's more than just a really nice truism. The concept actually won the Nobel Prize. Okay, a guy named Harry Markowitz discovered the relationship between risk and returns and how you're able to build a portfolio that actually reduces the risk of your investment without giving up any returns. It's considered the only free lunch in economics, aside from our lunch and learn today, of course. Came up with that one on the spot. So I like to show this chart because I think it just highlights the importance of putting together a basket of different investments to manage risk. So if you see emerging markets, right, 2007, this is just a ranking of the best performing asset classes by year. So it just ranks which was the best to the worst. And there's only 6 here. But emerging markets in 2007 was the best performing asset. What happened in 2008? Worst performing asset. 2009? Way back at the top of the list again. So if you were an investor and you decided, hey, I love emerging markets, I'm just going to buy emerging markets, what would your investment experience be like? 1 year, you'd be on top of the world. The next, you'd be, at the bottom of the pack. You'd be doing something like this every year, ups and downs. And why that's a problem is investors are generally really bad at managing emotions. If we have a really bad year, we start to freak out. We start to sell. And so managing the risk of your portfolio is really all about helping you be disciplined about sticking to your plan over the long term and not making emotional decisions when the markets go up or have a really bad year. And here's the power of it. Okay? We're looking at 3 different types of portfolios, and I just want to highlight how diversification can impact your returns and your risk. A typical Canadian will walk into a bank branch, and they'll be sold 2 mutual funds. One Canadian equity fund, so a basket of Canadian stocks, and one Canadian bond fund, just a basket of Canadian bonds. Those types of portfolios generally don't perform that well. You can see this data is about a year old, but it still holds true. That if you looked over the last 10 years up until February of last year, you would have seen that the returns to that portfolio would have returned about 2.25%. The risk, and we measure risk as the volatility, so how much your returns vary year to year, okay, was 13.3%. And the ratio, which is just the comparison of these two things, right, returns over risk, gives you a sense of how much return you should expect for every more risk you take on, for every more level of risk you take on. You see it's 0.17. So what happens if you go from 2 assets to 6? Add 4 more assets, really build a broader diversified portfolio. Your returns go up, your risk comes down significantly, and you can see that the ratio significantly improves, right? So you're actually benefiting more from every unit of risk that you take on. And just one more time, if you go from 6 to 10 assets, you can see an even greater juice to returns. And the reason this happens is you're getting exposure to different assets. So in the highest risk case, you might have some emerging markets. We saw that those have been quite performant assets over a couple of the years in the last 10 years. Real estate, which is a broader exposure than what you might have had in the 2-asset portfolio. What happens, so your returns go up, your risk actually goes up a little bit. And again, that's because emerging markets, while they were over the long term higher performing, had a lot more volatility to it. So you added more risk to the portfolio. But overall, the ratio is the best, the optimal in this case. So you're expecting the most return for every unit of risk you take on. So this is how this is the thoughtful approach to investment management that's based on Nobel Prize-winning research by Harry Markowitz on how to build a basket of different assets to manage your risk and returns over time. This is the type of stuff that we do when we build our portfolios at Wealthsimple. Okay, I'm going to show you how to do this in a much more simplified way so it's actually practical for you guys going forward, okay? Rule number 5, you got to drown out the noise. So here was like glued to the television this morning at 10 a.m. listening for the interest rate announcement. Okay, good, not that many. All of that is noise, and it's really important to drown it out so that you can be disciplined about your investments over time. The way to do this is you got to understand that every investor is different, and you want to understand the type of investor that you are. Are you someone that's going to have the wherewithal that in a market like 2008, you can stick to your plan, or are you someone that's going to panic and decide that you need to sell out? And that's a really important thing because you can design a portfolio that's specifically geared for your level of risk tolerance. So the way you can do that is go to any investment website. Any one of them will have what's called an online risk assessment. You go to Wealthsimple. It's really short, 6 questions. And asks you things about your ability to take risk, which takes into account things like how old you are, how much income you make, how stable your income is, and your willingness to take risk. So if you have experience as an investor, if you were investing in 2008, what did you do? How did you react to a market like that? And so once you do that, you'll generally get a risk score. And most of these sites will actually suggest a portfolio to reflect that. And you can get that at Wealthsimple, and you can take that if you want and actually go implement it elsewhere if you want to do it on your own. And if that's not enough for you, then I highly recommend you take those results with you and you go speak with a financial advisor. A lot of financial advisors are really great at helping clients assess their risk tolerance, their investment goals. And if you don't feel like you have the confidence to do it on your own, I encourage you to go out and get some help. But take your risk assessment with you so you're equipped with something to guide that conversation. Here's why it's so important to get in the right portfolio. This is my favorite slide in the deck. Okay, and I'll explain it because I know there's a lot of lines on here. What you're seeing is two different lines. The light blue line is the equity fund flows. So what this means is every year, a certain number of people buy mutual funds, a certain number of people sell their stakes in mutual funds. So if the number is positive, more people are buying mutual funds than they are selling. So the number of dollars in mutual funds are growing, right? So we call that fund flow. And the dark blue line is market returns. So how did the markets perform? What you see here is amazing. Kind of wish I had a laser on here, but if you see, like what happened in 2008? right? You see the market over the last few years has this tremendous bull run, generally positive returns over the previous few years. And as a result, you see that people keep plowing into the market. Fund flows have their record year in 2008. What happens next? The markets tank, right? We all know that. 2008 was a terrible crash, huge global calamity in the financial markets, came right down. And what happened to fund flows? People panicked, right? They started selling their stakes in mutual funds. And in fact, they kept selling all the way down through 2008 and didn't start buying back in en masse until 2013. But what happened to the market returns? They recovered really quickly, right? We had a crash in 2008, but then the markets came roaring back. And the last 5 years, 7 years as an investor have been one of the most rewarding bull markets in market history. But what did investors do? They kept selling. So they did exactly what you know not to do, which is they were buying high. 2008 was the record time to buy. And they were selling low. They sold all the way through to 2013. When they finally started to buy back into the market was already again at record highs. So this is why it's so important to know your risk assessment, to build a portfolio that reflects it, so that you can be disciplined to stick to your plan over time. That's the only way to set yourself up for success. So quick recap. 5 very simple rules to set yourself up for success as an investor. One is you got to start early. If you're not investing today, please get started. Do it consistently. Set up automated plans where you're just debiting your paycheck every month and putting enough away to set you up for long-term success. 2 is don't pick stocks. You want to buy broad index funds. Happy to walk through what those are afterwards if people want to stick around. 3, you got to keep your costs low. 1% or less, and you're going to be in really good shape for the long term. 4, diversify your portfolio. And you're going to do that by going to an investment website, doing a risk assessment to figure out what a portfolio that reflects the type of investor you is, and you're going to set that up. You're going to go open a brokerage account if you want, so that you can do this yourself, or work with a financial advisor to refine the results and get started. And this is just how you can do it, right? So if you decide you don't want to be a Wealthsimple client, and you don't want to work with a traditional advisor, but instead you'd actually like to manage your own money, here's how you can do it. Do the risk assessment. Get your portfolio. In fact, on Wealthsimple, if you go to wealthsimple.com/example, we'll show you the very ETFs that we use to build the portfolio. So not only will you get the kind of risk assessment and allocation that we'd suggest for you, but you get the specifics of the portfolio that we build. Then you can go to a brokerage website. Here are a couple we like: Virtual Brokers, Scotia iTrade. All the banks have their own brokerages, and you can set up an account. And then you just buy those ETFs. And then as you're contributing regularly, if you can set up an automated contribution plan, you're going to keep buying them with consistency and regularity over time. That's going to be how you set yourself up for success. If you want to go a step further and learn more, one of the best resources in this country is Canadian Couch Potato. That's kind of the gold standard for the do-it-yourself investor that loves ETF investing. Highly recommend that you guys subscribe to their blog and newsletter. And those are the basics of simple investing. Before folks file out, maybe I'll just run through a little bit about Wealthsimple quickly and how we help you achieve these 5 very simple rules. So 1, start early. We are by far the simplest way to start setting up an investment account in the country. And in fact, we have some awesome news to share with everybody today, is we just launched a brand new mobile app, which is the first way for Canadians to sign up and fund an investment account on your phone. And it might not seem like a huge innovation, but when we launched the business 10 months ago, we were one of the very first just digital onboarding experiences in the country. The vast majority of Canadians were still signing up for investments with pen and paper, walking into a bank branch and having to talk to a commissioned sales representative trying to sell them mutual funds. So now you can do it on your phone. Really, really simple. We're super excited about it. If anybody wants to, you can actually download it now, set up an appointment with your wealth concierge, and learn a little bit more about the service. 2, don't pick stocks. So I talked a little bit about what we call ETFs, which are these exchange-traded funds. And that's just a very fancy term for a mutual fund that trades on an exchange. They're generally less expensive than mutual funds, which is why we love them. I talked a little bit about the importance of not picking stocks, but I'm not sure I really touched on the importance of mutual funds and index funds in a portfolio. Generally, an index fund tracks a market. So whereas you might buy an individual stock like RBC and think that's a great investment, an index fund like the Toronto Stock Exchange, the TSX, would track the entire market of Canadian stocks. Generally, there are different ways to cut them up. There are ones that cover the entire market. There are ones that only look at big companies, small companies, companies that pay good dividends, and that sort of thing. But that's generally the basic building block of a thoughtful portfolio, is an index fund. And so when we construct our portfolios, and we do it broadly across different asset classes, so you can see that we're covering US stocks, Canadian stocks, emerging market stocks, bonds, and real estate, like really a broad portfolio. We do that with index funds. And we strongly recommend that as a great way to build a portfolio. Rule number 3 about keeping costs low. So the great news is you can actually try us out for free. We don't charge anything on the first $5,000 that we manage for our clients. And even after that, we're one of the lowest cost options in the country. So to just get started, it's 0.5% or less on your investments, and we grow with you over time. So as your assets grow with us as a client, we'll actually reduce the fees to you as you grow with us together. The other thing that's important to note is we hate fees. One of the terrible things about the investment industry is the total lack of transparency around where you're getting charged. So while they might say you're getting charged 1%, you notice on your statements you're actually getting charged commission fees and administration fees that were never up front. We have none of that. We charge 0.5%. The only other fee you pay is for the actual ETFs that we use. They average about 25 or a quarter to 0.3%. So all in, it's about 0.75 or 0.8% total, still below the 1% benchmark. And we have no other fees. There are no account opening fees. There are no transaction fees. There's no account closing fees. If you ever wanted to leave, you're welcome to take your money with you. We're never going to penalize you for that. It's your money. And in fact, our head of marketing wanted to make sure I made this message. You don't have to pay anything at all. If you invite a friend or family, we'll actually grant you both an extra $5,000 for free for every person that you recommend. So you can refer us as many people as you'd like, and we're happy to grant more free management as a result of that. Number 4, diversify. So this is how our process works. You come to the website, or now the mobile apps. You take a very simple 6-question risk assessment that's going to generate a portfolio for you. We're going to show you what your risk score is. We're going to tell you what that means. We're going to show you the different assets that we use to build the portfolio. And you're then going to be able to talk about those results with your dedicated wealth concierge. We call it just going to skip ahead here. We then assign you a dedicated wealth concierge. It's a registered portfolio manager. And unlike a traditional financial advisor that might take you to golfing once a summer or to lunch once a quarter to try and really build a deep relationship with you, we consider our service more of an on-demand advice service. So rather than having to go out of your way to meet with someone in person once a quarter, when you have a question, pick up the phone. Dave is one of the wealth concierges. He's on the phone all day and night. He's happy to meet with clients in person, or video chat, or texting is actually, I think, our most popular method of communication these days. So it's designed to be there for you how you need it, and to give you the sort of advice when you need it. So rule number 5, all about drowning out the noise and how we keep you disciplined to stay on track and really be thoughtful about your plan over time. So one concept in investing is called rebalancing, which is we work really hard up front through the risk assessment and your conversation with your wealth concierge to design this portfolio that's specific for you and your investment goals and your risk tolerance. Now, over time, that portfolio will drift. Certain assets will go up, certain assets will go down. And rebalancing is the concept that every so often, you sell some of the assets that have gone up and replace them with the assets that got down, so you get back to that target weight, your target mix. We're the only ones in the country that do this in an automated way. So we use technology to look at your portfolio every single day, and when these assets drift too far from where they're supposed to be on target, we will automatically trigger a trade that gets you back to your target mix. And this is a really powerful concept, because most people that do their own investing know the importance of diversification and rebalancing regularly, but it's easy to get lazy. So you might intend to do it once a year or once a quarter, but often forget and leave these things to manage later. So the way that we've been able to do this in an automated way is a really powerful tool for investors. I talked about the wealth concierge. And the third is it's really important we built a really safe and secure service. A lot of people used to ask us, especially after CIX up here, was, you're a 2-month-old company at the time. How do we know you're going to be around? We're now backed by some of the biggest investment institutions in the world. We raised our $30 million Series A back in April from Power Financial, which these are some of the companies that Power owns. Just one of the largest financial institutions in the world is now behind us in the service that we're building. So I love to be able to say we're not going anywhere anymore. If that's not enough comfort for people, we're actually protected through the Canadian Investor Protection Fund. So if people invest with us, up to $1 million insured by the Canadian government against, if the company were to go out of business someday, which isn't going to happen. We also have an additional $10 million of insurance through our brokerage partner, Virtual Brokers. So if you want to invest more than $11 million, maybe you can come up and talk to us a little bit afterwards, and we can figure out a solution for you. But anything less than that, you should be good to go. And in fact, as a huge thank you for coming here today, and if you're interested in checking us out, we're happy to give you all your first $10,000 managed for free. And again, you're welcome to try us out. If you decide to leave, which we don't think you will, we think you'll love us, there's no penalties or fees to taking your money back. So if you decide to try us, we're happy to give you your first $10,000 managed for free. Just go to wealthsimple.com/MaRS. And thank you so much for coming today. I'm happy to stick around and answer any questions.